The Japanese yen begins shaking quietly, then violently. A currency once known for stability is plunging to levels unseen in decades. Driven by political tension, power struggles, and growing global uncertainty. This is not a routine market slide. It is a warning signal coming out of East Asia. A currency collapse here doesn't mean the yen has vanished, it means Japan's money is rapidly losing value against major currencies like the US dollar, making imported fuel, food, and technology far more expensive and forcing governments and investors around the world to react. The issue is not just economic but strategic. When a major economy weakens, others move, and China is moving. As Japan fights to stabilize its currency, Beijing is sending financial signals, adjusting policy quietly, and strengthening its position inside the global monetary system. Behind closed doors, China is reducing its reliance on the dollar and slowly challenging the G7-led financial framework, turning the yen's decline into part of a much larger contest over global influence. A weaker yen helps exporters but hurts households. Prices rise faster than wages. Companies face higher import costs, and social pressure grows. When domestic stress builds, foreign policy shifts. Meanwhile, China has spent years building trade networks, payment systems, and currency influence across Asia, Africa, and parts of Europe. As Japan weakens, China sees an opening to reshape financial flows without fanfare. Through long-term deals, alternative systems, and quiet realignments. In this video, you will learn why the yen is falling, what forces are driving it down, and how China is responding behind the scenes. You'll also see how this affects global trade, energy, investments, and currencies worldwide. Most importantly, you will discover 3 realistic future paths if this tension escalates, each with different consequences. If you're interested in global finance and hidden power dynamics, this is for you. For years, Japan kept interest rates near zero while other countries raised theirs. The goal was to fight decades of deflation, but this pushed money out of Japan and made the yen unattractive, especially as demographics weakened growth. Now inflation has returned, not from domestic demand, but from higher import costs due to the weak yen. Everyday essentials become more expensive, while wages barely move. A softer yen boosts exports but increases vulnerability. If confidence falls, the yen can drop even further, raising long-term risks. The Bank of Japan faces a tight dilemma: protect economic growth or defend the currency. Each option comes with consequences. The yen's volatility reflects growing market doubt. Officials have warned they might intervene by using foreign reserves to buy yen, but interventions are expensive and temporary. Japan is also hinting at future rate hikes, but higher rates could slow the economy and increase the burden of its massive debt. As the yen falls, analysts watch China's response. A weaker yen makes Japanese exports cheaper, so Beijing may allow the yuan to gradually soften to stay competitive. This subtle currency shadowing has happened before and risks triggering a cycle of competitive devaluation. But China's goals reach further. It is building a parallel financial world. Regional payment networks, yuan-based trade deals, digital currency trials, and agreements that bypass Western systems. As Japan struggles, China's influence grows quietly. This slowly shifts economic loyalties and regional balance without dramatic announcements. Meanwhile, ordinary Japanese households feel the sharpest impact. Higher energy bills, pricier food, more expensive goods. Savings lose value. Stress rises gradually but persistently. Stabilizing the yen requires tools that come with costs. Intervention drains reserves. Rate hikes slow the economy, and delay invites more volatility. The effects spread through Asia's interconnected markets. A falling yen disrupts supply chains, trade flows, and investor confidence, triggering broader instability. Strategically, Japan becomes more constrained while China gains leverage. One possible future is decisive Japanese action, intervention, rate hikes, stabilizing the yen, and calming volatility at the cost of slower growth. Another path is disorder, delayed action, deeper inflation, more volatility, political pressure, and regional instability. The third path involves China advancing more assertively, weakening the yuan, expanding yuan-based trade, and drawing countries into its financial orbit. Global markets begin to split into competing systems. These futures overlap and depend on choices made quietly in central banks and political rooms. The yen's fall is not just economic, it is a shift in power and influence. Japan is defending its position in a changing world. China is testing how far it can expand within a system it did not build. This is why the yen's decline matters globally. Watch the Bank of Japan's upcoming decisions, China's yuan management, and the G7 South response. These will shape financial flows, power shifts, and global stability in the years ahead. If you want to stay ahead of these changes, stay with us. Like this video and subscribe for more clear, deep explanations of global finance and geopolitics.